So today's topic is inventory and biological assets. International International Accounting Standard 2 deals with inventory. Okay. So as you know, always like we are studying two standards here, IS2 and IS41. We will see what is the definition of IS2. Always when I speak about any standard, I say a standard tells you about recognition criteria, measurement basis, and disclosure requirements. These are the three things a standard gives you guidance about certain element or certain element of financial statement with which it is dealing. So IS2 is dealing with inventory here, and henceforth IS2 will tell you about the IS2 will tell you which particular things you have to recognize as inventory, how to measure them, and what should be the disclosures regarding that inventory. Same thing goes with IS41, how to recognize something as an agricultural product, what should be the recognition criteria for that. As I always tell you, if you want see inventory, we always say that inventory is an asset, right? Why we say inventory is an asset? Because inventory satisfies with the definition of an asset. So that is always the recognition criteria for anything to be shown in the statement of financial position or statement of profit or loss. Okay, because we know there are four things: expense, income, asset, liability. So there are definitions for all this. So something which satisfies with the definition of an asset will be shown as an asset, right? But every asset has a different characteristic, different attribute. So the standards would tell you particularly about that asset. Now, particular standards will tell you particularly about that particular asset. Now, same thing with IS 41. We'll see the definition, we'll see the recognition criteria, measurement basis, and disclosure requirements. Let's enter into the subject deeply. IS2 lays out the required accounting treatment for inventory, as I said. Now, we call inventory as an asset, right? Why we call inventory as an asset? Because inventory is something on which we expect future probable economic benefits, and its cost can also be recognized. Its cost can also be measured reliably. That is what is the definition of an asset, and inventory exactly matches with that. Okay. See, let's start with something. So you bought 100 boxes, right? These 100 boxes are what for you? Inventory. What is inventory? Asset, because it will give you economic benefits in the future, right? Now, out of these 100 boxes, 20 boxes are sold now. Isha, you just unmute your mic and answer my question.
Yes, sir.
20 boxes are sold. Now, when I sell 20 boxes at the rate of $10, $8 is what I have bought the inventory for per box. Just a second. Now $8 I bought the boxes, for $10 I am selling the boxes, right? The point is, this inventory now of 20 boxes will be still shown as an asset or what?
Yes, sir. It will be shown as it.
Never. This is sold now. So we have to show this 20 boxes purchase cost under COGS. And the leftover 80 boxes what you still have will be an asset. Are you understanding?
Yes.
First, when you bring the asset, it is with you. See, the first question what a student will have is, sir, I bought 100 boxes, right? These 100 boxes has costed me. I have paid $8 for each and every box. So what is this actually? Is it an expense for me or is it an asset for me? So the answer to the question is, when you bring the inventory at once, the entire lot, okay, and it is with you today, and it is not in the process of sale right now, it is with you, you are holding it, just holding it. Whenever it is held with you, it is always an asset. That's the reason why we say closing inventory is always an asset. Am I right?
Yes, sir.
But when next day some inventory, some part of inventory, if you are selling to the customers, that point of time you have to recognize the purchase cost as well, because now it becomes routine for you, right? Trading is routine activity for the business. So whenever you have a routine activity, recurring activity, then definitely recurring nature expenses have to be accounted in the statement of profit or loss. Isn't it so?
Yes, sir.
Because you have spent money to buy that, right? And as per the matching concept, for every revenue there should be a cost. For every dollar earned there should be some dollar or cents to be spent, right? So the point here is 100 boxes, like when we bring, we are holding it, it's an inventory because it will give us future economic benefits, and definitely next day it is going to give some part of this is sold, right? So the part, how much part is sold out of it? 20% out of it sold. So 20% when we are selling, there should be some cost to be recognized. So that cost is purchase cost, should be shown under COGS, right? And now still leftover 80 boxes are with you. And this is nothing but you are holding, still holding this and waiting for the next day. So this will be a asset for you, right? Shown in the statement of financial position. This is SOP. Shall we move forward? Yes. So inventory are recorded as asset of the entity until they are sold. Was I right here? Yes. At
Yes, sir.
which point the asset inventory is derecognized and an expense is recognized. Yes. So 100 boxes out of that 20 you are selling. So that means now it is not an asset for you. It will be derecognized as an asset and recognized as a cost. When you are selling it. Now, inventory assets that are held for sale in the ordinary course of business, in the process of production as raw material, yes, in the form of material or supplies to be consumed in the production process, or in the rendering of services. So all these are inventory. So inventory is not only stock, also in form of material or supplies to be consumed in the production process or in the rendering of services. That means you will be using it for giving some service as well to someone. So there are some examples of raw material, and here in the production, in the process of production for such sale, that means definitely raw material will be utilized, right? And in the production process, and that will be again sold in the market. Or see, I'll tell you inventory now. If some clarity has to be given, the very good clarity what they've given is inventory is raw material which is with you, and you are going to send this for the production process. It can be work in progress. The inventory which is still in production process has not become finished goods, and also finished goods is also inventory. All this will be shown in the SOFP. And goods purchased and held for resale is also an inventory, right? This is in merchandise or the retail shops too. Measurement, always please understand, inventory are always measured at lower of cost and NRV. So I'll write the point here. So recognition is done, right? We are done with recognition criteria. Now we are going with the measurement basis. Lower of cost and NRV. NRV is what? Selling price minus cost of disposal. Cost is the cost price. Why this rule is applicable, Isha? Can you tell me? Any clue? Hello?
No, sir.
Hello? Yeah. Can you tell me what is the reason behind lower of cost or NRV rule?
No idea, sir.
See, so lower of cost and NRV. Suppose you bought something for $100, right? This is your cost. Now in the market, now the value of this has gone down because it is held for longer period of time. It has become $30. Now you tell me what makes sense. You want to still show at cost, or you will show at $30 because it seems more realistic?
$30.
Of course. $70 you will recognize as inventory loss in the COGS or statement of profit or loss, and you'll be showing the inventory at $30 because it makes sense. It is the realistic value of that, right? Is it so? Yeah. And suppose the cost of the inventory is $100. Somehow, yeah, the selling price. What do you mean by NRV? Selling price minus cost of disposal. That means some commission you are going to give to agent for selling the goods. So let's say $100. You are able to sell it for $150 minus $10 commission. So 140 is the NRV, right? Selling price minus disposal cost. So it can be sold at $140 now. Now you tell me what price you'll be showing in the books. I know it can be sold at 140, but still it is not sold. Something which is not sold till now, will you show the selling price of that in the books?
No.
Will you?
No, sir.
Of course. So again, the rule of lower of cost or NRV. Here cost is this, here NRV is this. The lower of this is $100. We can show the inventory at cost only. Here the cost is this, the NRV is this, and the lower is $30. We can show it lower of cost or NRV only. Why? Because this looks realistic, right? Shall we move forward? Hello.
What, sir?
Shall we move forward? I said.
Yes, 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 sir.
And here when you will be selling the inventory next day, $40 of profit you will be recognizing. So cost or NRV rule is also done. This one I have explained, given a practical example. Components of cost. Now what are the costs related to inventory? Cost of inventory comprise of all cost of purchase, cost of conversion, converting into finished goods, converting the raw material into finished goods, another cost incurred in bringing the inventories to their present location and condition, that is freight charges. So this is what is the inventory cost. First, purchase cost, add conversion cost, then add all the expenses which are directly related to inventory, that is bringing the inventory from one place to our go down. I will say as freight charges, any import duties, and one more thing, if you got some trade discount, that also you have to deduct. Okay, and any charges only incurred only incurred once, that too at the inception while bringing the inventory from suppliers factory to our go down, are all inventoriable cost, will be added to inventory or capitalized. That means will be added to inventory and shown in the balance sheet. Then whatever the aftermath expenses like go down rent, salaries, insurance what of the goods which you are holding, and the salary to the go down in charge. Okay, and all these expenses are aftermath recurring nature expenses, not spent once but spent usually, or will be spent very often. So all these are expensed, shown in SOPL. Okay, all these are added to the inventory and shown in SOFP. Right now, listen. So cost of purchase price and less any trade discounts or rebates, import duties, I told, and all the directly attributable cost of acquiring the inventory, including delivery and handling cost. Conversion cost is nothing but you'll be using material, labor, and you'll be converting and all the manufacturing overheads, etc. You'll be converting the raw material into finished goods, right? And other cost also I have explained you, like cost related to bringing the inventory to their present location and condition, which are not already included in the cost of purchase. For example, non-production overheads, like some designing of the product, etc. for some specific customer. Yes, and all this should also be added up. Okay. So whatever is directly attributable cost should be added up. Whatever is like you're spending on routine nature, you should be expensing. So I gave the examples of that. Isha, did you understand? Hello.
Yes, sir.
So fixed production overheads relate to indirect costs such as cost of factory management and administration, which remain relatively constant regardless of volume of production. Yes, they are speaking about overheads. Overheads always are indirect expenses. I have many times mentioned, and these are of fixed nature. Cost of factory management and also administration. So these are always constant irrespective of level of production, what you do, volume of production, what you do. You produce more or you produce less. This is what is fixed. These should be allocated to units of production based on normal level of activity. Allocated means should be put into that category completely. Variable, what do you mean? What is the difference between allocation and apportionment, Isha?
Apportioning means distributing, sir.
Then what
According.
is allocation?
Yes.
This is department A, this is department B. Supervisor of department A. So giving salary to the supervisor of department A is allocation, because supervisor salary I will be paying under department A. Okay, because he is supervisor of department A. Salary of supervisor in department B I will be paying under B. Right? This is allocation. Are you understanding?
Yes.
Allocation means putting the expenditure in particular one total category. Now there is a manager who is managing both the department A and both the and department B. The salary what we are paying is $10,000, and he is giving 50% of his time here and 50% of his time here. So now we will apportion, because this is the common cost for both. Are you understanding?
Yes.
That's what allocation is, putting one thing in that category completely. So A's salary will not be shown under B. It's a known fact. B's will not be shown under A. Known fact. A's will be shown in A, B's will be shown in B. But 10,000 can be shown in both. That is 5,000 and 5,000. That is apportionment. Many students really have a doubt in this. Now, variable production overheads include indirect materials and labor vary with the volume of production. Understood fact, right? Because it's variable. You more the activity, the more the expenses, right? So I have given you the entire detail about the like what kind of expenses should be added to the inventory and what kind of expenses should not be added to inventory, right? Shall we move forward?
Yes.
See, I had inventory chapter video of FR, sorry, FA, but like uh, that is also totally the same concept, no difference. But I said, okay, let's take a live session. Determining cost. The cost of inventory should be the actual unit cost of the item. It can prove difficult to determine, and so estimation methods may be used for convenience if the results approximate to actual cost. So there are some methods we are using to find out the inventory cost. The methods are here: standard cost and retail method. Standard costs are always estimations, right? So cost is based on normal levels of material and supplies, labor efficiency and capacity utilization. Standards must be regularly reviewed and revised where necessary. So I will say always this as estimated costs. Retail method is cost determined by reducing sales value of the inventory by appropriate percentage gross margin. Yeah, so it is nothing but 100 minus, so selling price minus, let's say 20% is the profit. We get 80 as cost. Okay, this is margin. There is also markup, right? Hello.
Yes.
In markup, what we do? 100 plus 20, 120.
Yes.
There we take cost price plus profit selling price. But
Hmm.
in retail method, what are we doing? We are reducing the sales value with some profit percentage, right?
Yes.
And the percentage used takes into consideration inventory which has been marked down to below its original selling price. This is often used in retail industry for measuring inventories of rapidly changing items that have similar margins. So this is the method you have to use. Interchangeable items. See what happens when you have many different types of items and different types of pricing, and you have layers of inventory. Then what method you have to use to find out the COGS or cost of goods sold, FIFO and weighted average, right? Hello.
Yes, sir.
You know about FIFO method, right? And you also know about weighted average method. Do you have idea or shall I share the videos of this?
I can share it on C today.
Basically, I have inventory videos with me. So just a second. That can be very handy for you. Just a second. Inventory. Okay, I'll see and check Isha and send you. Okay, within some time. Now,
Yes, sir.
so in that you will be learning about FIFO and AVCO, and then you can find out the cost of the inventory with that. All are approximate costs, not actual cost. I've explained to you about NRV, how to find out NRV right now, correct? And I have also explained about this rule, NRV and cost rule. You have to apply that right now. Can you do this illustration one?
Yes, sir.
The following figures relate to inventory held at year end. The cost is given for A, B, C. Selling price is given. Modification cost to sale is given. Marketing cost is given. So what you need to do, you need to subtract these two from selling price to find out NRV, and then you have to compare that with the cost to just save, like, lower of cost or NRV will be the cost of your inventory, right? So they have done that. They have taken the cost. They have done the NRV. Okay. They have the number of units as well with them. Units held, and the cost is given to you, right? So cost. So what is the rule here? Lower of cost or NRV. So from with when compared to 2320 is less, right?
Yes.
Taken here from 9 and 8, 8, 12 and 10. What? Lower of cost and NRV. Here 10 should be taken. So printing error. No, just a second. The cost is 12. 22 minus 10 is 12. So there is no more or less. Actually, this is wrong, right? It should be 12, right? 22
Yes.
minus 10 is how much?
12.
So there is no more, there is no higher value, no lower value. So this is the value. So these are the total values of the inventory, right? Shall we move forward?
Yes, sir.
So, write down of inventory, I've explained you already that you have to reduce the value of inventory when the inventory value is falling, right? To show the inventory loss. Will you do this particular question? Then we will move into agriculture. It's a 10 minutes concept now. Done this chapter. Start, do this.
Okay.
Yes, are you solving?
Yes, sir. The NRV is 2.80.
2 point.
8.
Okay.
2.8. Okay. It's 1,125.
1,125.
125.
So what did you do here?
I took the selling price, sir. 5.3.
So Teddy company has 500 items of product HGJ in inventory. These items are no longer saleable in their current condition. However, they can be adjusted to a cost of 2.50, right? So 2.50 is your cost. And once adjusted, the item can be sold at 5.30. This is your selling price.
Yes.
But actually, original cost is this, but we'll be taking the adjusted cost. Why? Because some adjustment has been done as per the current conditions, right?
Hmm.
So selling price minus the cost, adjusted cost. So when you subtract the adjusted cost from selling price, you get NRV, right?
Yes.
Adjusted cost is some adjustment to be done in the selling price. So NRV is that cost of disposal or something should be there. So your NRV is 2.80, right?
Yeah.
So 2.80, and then like what is our actual cost?
2.2.
NRV and cost. What is lower of NRV and cost here?
2.2.
2.25. Into what are the number of units or items you have?
500.
So answer is 1125. Okay. Shall we move forward?
Yes, sir.
And all the disclosures related to inventory should be disclosed in the disclosure column of the financial statements, that is footnotes. So you should be showing the accounting policies, what you're using for measuring inventory, and also the cost formula. Methods what you're using for determining the inventory cost should be shown. Total carrying amount of inventories and carrying amount in classifications appropriate to entity. Carrying amount of inventory, that means the book values, the value which you're showing in the balance sheet at fair value less cost to sell, that is at NRV. What is the NRV you have to show? Like whenever you are selling the inventory, how much you have to recognize the expense. If the inventory value is falling, then it should be written down and the expense should be recognized. The amount of any reversal, here also the inventory value was falling, right? The adjusted cost was this, right? So from here to here, so difference amount is this, you can sell it. And any kind of inventory loss should be recognized. Any kind of reversal of any write down, that means inventory value has gone down and again it got reversed, has come up, that is also recognized. Are you understanding?
Yes, sir.
Reversals you have already studied in tangible assets, right? And what are the circumstances of that reversal, and also some inventory are always used as the security deposits or are pledged for taking loans. So what kind of liability has got created because of that inventory we have to show. Then comes the next standard, that is IAS 41 agriculture. See, what comes under agriculture is it is something which deals with the treatment of biological assets except the bearer plants, because bearer plants goes under IAS 16. Property, plant and equipment like rubber trees, palm oil, they give you rubber trees give rubber for a very long span of time. So you get economic benefits not within 1 year but more than that. So it cannot be taken under the category of agriculture, it will be taken the category of property, plant and equipment, right? So this particular standard deals with all the biological assets except this, like rubber trees. I have given an example to you. Did you understand, Isha?
Yes, sir.
Palm oil, all these are for long term. And agricultural produce at the point of harvest. Important point, this is point of harvest, right? Till the point of harvest, the standard IAS 41 is applicable, but once the agricultural produce is ready for sale, which standard comes into picture? IAS2 inventory, right? So first you will be planting the seeds, you will be sowing the seeds, okay, or the birth of some offspring of some animal will happen, either sowing the seeds, that is planting, or birth of some offspring of some animal like sheep, cattle, some cattle. Then what happens, this particular seed will blossom and it will transform into some plant or tree, right? Or this cattle will grow in size and shape, and then one day this particular plant or tree will bear some fruits and you'll harvest, or the slaughtering of that particular cattle or animal will happen, and then it will be sold to general public, okay, and here the revenue will be generated. So it was like raw material, here it became the finished goods, and here then IAS2 is applicable. Before that IAS 41 is applicable. Please tell me yes or no.
Yes, sir.
That's what, so already explained. So that's what I said you here, bearer plants, instead they are accounted under IAS 16 using either the cost or revaluation model, already have explained, right? So bearer plants will grow, but you cannot, but are not themselves consumed like grape vines. Now definition: biological assets, living plants or animals. Biological transformation, growth stage. Agriculture produce the harvested product of an entity's biological assets. Recognition, as with the non-financial, as with other non-financial assets under the concepts of framework, a biological asset or agricultural produce is recognized when the entity controls the asset as a result of past events. Of course, it should give you probable economic benefits, and the fair value or cost of that should be measured reliably. Then only you can recognize that as an asset, right? Yes. First, you should have control of that asset. Second, you should get some benefits. Third, it should be measured reliably. Now comes the measurement. This is the final part, I think. Above this, nothing is there. Biological assets are measured both on initial recognition and at the end of each reporting period at fair value less cost to sell. Very important. That is NRV. So biological assets are measured both on initial recognition and at the end. So you always recognize biological assets at what? Hello.
Yes, sir.
At what I said?
NRV.
NRV. Initially or at the end. Because always you have to find someone to sell that particular biological asset, right?
Yes.
Agricultural produce at the point of harvest is also measured at fair value less cost to sell. Now, so this is what the fair value less cost to sell of agricultural produce harvested becomes its cost under IAS 2. So what it is under IAS 41 becomes cost, only cost under IAS 2, right? Because it is changing the stage. Now from the point of harvest to it is going into the market. Now it will be treated like an inventory, correct?
Yes.
Now, because see, all the farmers have always like problem or issue of selling the goods. So what they do is they whatever they have produced, they will see what is the market value of that, and some cost they'll deduct from it, and then that becomes the inventory cost. After harvest, agriculture produce is measured at lower of cost and NRV value accordance with IS2. That means once the harvesting is done, till the harvest point, it is what? NRV. After harvest, lower of cost or NRV, correct?
Yes.
That's understood fact, right?
Hmm.
So till harvest, I'll write here, till the point of harvest, NRV. And then this is under IAS 41. After harvest, when it comes to market, IAS 2, lower of cost or NRV. Now, fair value is the price that if you sell the asset, what market participants are ready to pay you. Cost to sell are incremental cost directly attributable to disposal of asset. Example, commission to brokers and transfer taxes. I already told you, cost to sell is nothing but the cost of disposal, right? So you have to pay commission to the agents, etc. So from fair value, if you remove the cost of disposal, you get NRV. Changes in fair value cost to sell are recognized in profit or loss. Very important feature. So now you have the fair value of your agricultural produce, that is $100. It has gone to $120. You have to recognize $20 as profit. But why, Isha? You have still not sold this. The point here is you will definitely sell it. The intention here is to sell, right?
Yes.
This is always available for sale. When the intention is to sell, any changes should be shown in SOPL.
Yes.
Not like physically it is sold and you'll show, but any changes in fair value less cost to sell, that means any changes in the NRV should always be recognized in SOPL, where fair value of biological assets cannot be measured reliably. See, if you don't have fair value, then it should be measured at cost less accumulated depreciation and impairment losses. Did you understand?
Yes.
Where fair value is not available, then cost less accumulated depreciation and impairment loss. And biological assets are presented as non-current assets. This is the presentation. Done with this. Just go for this example and finish this chapter. So what's the answer? Which of the following are the examples of biological assets? Do you think sheep is a biological asset?
Yes.
Fruit trees?
Yes. I feel.
Wool?
It is processed, no, sir.
Yeah, wool is inventory actually. Fruit juice is inventory actually. Sheep is in growth stage. Fruit tree is also growth stage. So we can say the biological assets are 1 and
2.
right? Okay. Then we are done with this chapter, Isha. What we can do, see, I will check what is left over. So we'll take a next class also, backup class. See, provisions and contingencies is not done, right? I'll check whether a video is there or not. I have a video of this. Shall I send this?
Okay.
This will be done. I will take up taxation tomorrow morning. Okay, Isha? Evening, if I get time, I'll try to take consolidation question. Okay?
Okay, sir.
Okay. Now, like I have only 2 chapters, that is taxation and financial instruments. Now tell me, Isha,
Sir, impairment.
impairment is there, right? Okay. Intangible assets,
Huh. Not sir.
there or not?
I don't have that video, sir.
So I will send intangible assets today and also will try to send impairment provisions. Okay. Hello.
Okay. Yes, sir.
Okay. Okay. Well, I'll send and I'll message you. Okay, Isha.
Okay.
Okay.
Thank you,
Okay.
sir.
Thank you. Thank you. Prepare this. Thank you.